Bonds have had their worst period for investors ever. You're going into this year, the 5-year compound return of the aggregate bond index was negative. That means you earned on average negative for 5 years. That's terrible. That's never happened before. But guess what? That's usually when it means it's a decent time to be investing. And so you look at one simple thing we look at. We look at the earnings yield of the S&P 500. So that's basically how many dollars in earnings do you get divided by the share price. So it compared to the bond yield of the 10-year treasury. So earnings yield is basically the inverse of the price earnings ratio, which you've probably heard about, versus the 10-year treasury. And guess what? Stocks are riskier than bonds. There should be a premium there. You should get paid a premium for taking risk. And when you looked at the beginning of the year, anyways, before things have moved obviously since then, look at the beginning of the year, that they were at parity. The last time that happened, Joe probably knows, it was 1999, like he's been saying. It gets back to, you look at the discrepancy in returns between the top of the market and the average stock. You look at the pricing of stocks versus bonds. It all goes back to 1999.